All right, I think we will get this little soiree underway. It's amazing how we all sort of retreat to our classroom norms here with everyone sitting in the back. But in this situation, I sort of understand. If you're down in the front, it's like being at the super screen at the Marcus Theaters looking up. So my name's Kyle Swanson, and it's my distinct pleasure to welcome you to the UW-Marden Lecture on Mathematics for 2015. Each spring, and I'm using that word very lightly today, our department invites a distinguished mathematician to Milwaukee to give a public lecture in mathematics. The Marden Lecture is named for Professor Morris Marden, who founded the PhD program in mathematics at UWM at a time when the university did not have any PhDs in any field of study. And indeed, the 50th anniversary of the first PhD granted at UWM is 2016, will be coming up next year. Stay tuned for that, because that PhD was in mathematics. We're grateful to receive continuing support from the Miriam and Morris Marden Fund, which has made this lecture possible for the last 26 years. Today, we're honored to be joined by Maury's son, Philip, and Philip's wife, Cheryl. They're up there midway on the back, on the left. And I'd like to thank them for joining us and supporting the program that Maury truly gave his heart and soul to. I think he'd be proud of what we've become over the past 50 years. So we're looking forward to actually graduating a record 11 PhDs from our program this spring. This year's Marden Lecture will be given by Steve Shreve from Carnegie Mellon University. Steve is the Orion Hawk University Professor of Mathematics at Carnegie Mellon University, where he co-founded the CMU Master's Degree in Computational Finance, now in its 20th year, with campuses in New York and in Pittsburgh. He received his MS in Electrical Engineering and his PhD in Mathematics from the University of Illinois. He's also been a faculty member of the University of California at Berkeley and at the Massachusetts Institute of Technology. Professor Shreve's book, Stochastic Calculus for Finance, won the 2004 Wilmot Award for the best new book in quantitative finance. He's the co-author of the books Brownian Motion and Stochastic Calculus and Methods of Mathematical Finance. He's an advisory editor of the journal Finance and Stochastics and past president of the Bachelier Finance Society. He's published over 40 articles in scientific journals on stochastic calculus, stochastic control, and the application of these subjects to finance, including the effect of transaction costs on option pricing, the effect of unknown volatility on option prices, pricing and hedging of exotic options, and models of credit risk. In other words, he's a troublemaker. And that's what he's actually going to be talking about. So without further ado, let's welcome Professor Shreve, who will be lecturing on Lessons Learned from the Financial Crisis. Let's give him a warm welcome.
Well, thank you, Kyle, and I'd like to thank the Department of Mathematical Sciences for the invitation to give the Marden Lecture. I'm honored to be here today in Milwaukee for the first time. I thought it would be safe if I agreed to come in March. But it turns out that the weather is worse today in Pittsburgh, so this is a good place for me to be. I'm going to talk about lessons learned from the financial crisis, and I'll start by saying that this is sort of a five-part talk. I'll first list some of the reasons that we had the financial crisis, or at least some of the reasons that have been given. Then I'm going to have to take a detour and talk a little bit about mathematical models in finance. There will be a little mathematics here, but I hope not too much, because I was told to talk to a general audience. And then I'm going to return to financial instruments, and namely the culprit in this particular financial crisis, mortgage-backed securities. These are both good and bad, and so we talk about them twice. They're ugly as well, but I didn't have room for a third topic. But I will at the end then talk about well, where are we going from here? I'm terrible at predicting the future, and so I've given up that. But I will just make some observations and let you draw your own conclusions, perhaps, about where we're going to go from here. So this is what I intend to talk about today. And again, I would like to start by asking, well, what is it that caused the crisis? And putting up 5 possibilities for your amusement. So different people give different answers. There's the answer that the general public, I think, gives, which is that the financial industry is run by a bunch of overpaid, greedy scoundrels. There's some truth there. There are the anti-intellectuals who say the quants, that's the pointy-headed physicists and mathematicians, destroyed our financial system. That strikes home. There are the Republicans. The U.S. housing policy encouraged government agencies to give too many mortgages to unqualified buyers. The Democrats lax regulation of the financial sector. And then the finance industry, of course, has its own answer, which is a little longer than the rest. Too many dollars held by foreigners in a low interest rate environment, seeking to find better than average return in U.S. fixed income markets created a bubble. And in fact, I would submit that there is some truth in all of these assertions, but since the second one is the one that strikes home for me, and that's also the one that's closest to where I am, I'll talk about that one today and leave the others to the policymakers. And in order to talk about that, I need to talk first a little bit about what are these mathematical models that get used in finance. And I will do that in what I hope is, as Einstein said, the simplest explanation possible, but no simpler. So let me introduce a problem that shows up in finance in the simplest setting possible. This is a one-period binomial model for those of you who teach math finance. I imagine that I have a stock, and a share of this stock is priced at $2 at time 0, which I'll think of as today. And I'm going to flip a fair coin. And if I get ahead, the price of this stock is going to double. Whoops. It's going to double, and it will go up to $4. This is at time 1 if I get ahead on my coin toss. And if I get a tail, it'll go down to $1 at time 1 if I get a tail on the coin toss. So there's a very simple model of a random evolution of a stock. And now let's introduce a call option. So this call option is a contract, and it confers on its owner the right to buy 1 share of stock at time 1 for $1. So at time 1, you have a contract that will allow you to buy this stock for $1. If at time 1 the stock is going up and it's selling for $4, what you can do is you can use your contract and buy it for $1 and immediately turn around and sell it on the market for $4, and you get a $3 payoff. So I'll call that's the payoff of the call at time 1 if we get ahead. If we get a tail, well, you have the right to buy the stock for $1 at time 1. If we get a tail, it's selling for $1 on the market. That's essentially worthless. And so the payoff of the call is 0. And the question before the House is, how much is this call worth at time 0 before we know whether the stock is going to go up or down? And I'm going to throw in something here which may seem extraneous, but I'm going to allow you to borrow or invest money at a 0 interest rate between these 2 periods, between 0 and 1. And so what is this call worth at time 0 before we know whether the stock is going to go up or to go down? There's a naive answer, which of course is the wrong answer. And the naive answer says, well, we're assuming that this is a fair coin. So there's a 50% probability the stock will go up, and there's a 50% probability it will go down. So I could take these 2 payoffs, the 3 and the 0, and I could average them and say, well, at time 0, before I know whether it's going to go up or down, it's worth the average, $1.50. And now let me try to convince you that that's not the right answer. So I'm going to give a different solution. It's the solution of replication, and it goes something like this. So here's my stock, here's my call. I'm going to start with $1 at time 1. So I'm sitting here. Actually, I'll let you do it. You're sitting there and you've got $1. And you're pretty wise, and you decide in your wisdom that you're going to borrow another $1. Now you have $2, and you're going to buy a share of the stock because it's selling for $2 at time 0. And now what happens? Well, at time 1, if the stock goes up to 4, you have a portfolio. Your portfolio is that you own a share of stock and you owe $1. And if the stock goes up to 4, the portfolio you have is the stock is worth $4, you owe $1, so we'll subtract that off, and so your portfolio has a value of 3. And that's actually the call payoff at time 1 if the stock goes up. And if the stock goes down, well, you have a share of stock, it's worth 1, but you owe $1, so you subtract that off, you have 0, and that's exactly what the call payoff is at time 1 if the stock goes down. And so you have replicated the payoff of this call by starting with $1, borrowing another $1, and buying a share of stock. And now you've got a portfolio which pays off exactly the same thing as the call pays off. And I would argue that means, since you need to start with $1 in order to do this, that the price of that call at time 0 ought to be $1. Because think of what happens if somebody is willing to pay $1.50 for it. Okay? So suppose you can find somebody who's willing to pay you $1.50 for that call. You should sell him as many as he will buy. Because for each one you sell, you can take $1 from the sale, and you can do that replication on the previous page, and you can have exactly what you need to pay off the call to him at time 1, and you get to put 50 cents in your pocket. And so you will sell him as many as he's willing to take. And in fact, you will keep selling to him until, and all the others out there who are willing to pay more than $1 until the price of that call falls to $1, at which point there's no point in selling anymore. And in fact, you can turn that argument, I've said that already, in fact, you can turn that argument on its head. As long as someone knows how to replicate the call, the price also cannot be less than $1, because if somebody is willing to sell you a call for less than $1, you should buy from him, and then you should just do the negative of what I described before. It involves selling the stock short and investing money, and you can make money again as long as somebody is willing to sell you calls for less than $1. As long as there's anyone in the market who knows how to replicate, he will make these trades and force the price of the call to be $1. So that's my mathematical model. I'll pause here and see if there's any question. Okay, so the naive answer is wrong. The replication answer is a much better way. If you believe, there are a lot of assumptions. It's a very simple model. There's a lot of assumptions here. But if you have a model with all these assumptions, the replication sort of gives you the only reasonable price for this call, and it's $1 at time 0. So owning a call which pays a random amount at time 1 is equivalent to having a non-random amount, namely $1 at time 0, because with that $1 you can produce the random call payoff. So this brings us to the Black-Scholes, and I think Merton should get equal billing here model from 1973. Merton shared in the Nobel Prize for this work, and they used this replication idea in a much more complicated setting. In particular, they allowed the stock price to move continuously in time. The stock price can take any positive value at every time, unlike my simple model where it can only take 2 values. The call option pays off the following formula. There's something called the strike price. That's how much you're going to be allowed to purchase the stock price for at time capital T. Capital T is the time when the call pays off. If the stock price at capital T is more than the strike price K, then the value of the call or the payoff of the call is this positive difference. If the stock price at time T is less than K or equal to K, the call is worthless, and so it pays off 0 at time 1. So I've summed up the 2 cases by saying the call payoff is the max of these 2 quantities. The call payoff is random because the stock price at time capital T is random. We don't know what it is. And we want to know what is the price of the call at time 0 before we go out to time capital T. And there is a unique non-random initial capital, I'll call it C0, that permits replication with probability 1. That is to say, there's a way to start with that initial capital C0 and to trade in the stock, and also a money market account, which I'll describe in just a moment, so that at the time capital T, I have exactly the payoff of the call, regardless of which path the stock price follows between 0 and capital T. And that C0 then is the price of the call at time 0. And Black and Scholes gave this formula, the only formula, as far as I know, that ever appeared on the front page of the New York Times. And it has real mathematics in it. The price of the call at time 0, well, it depends on the initial stock price, the stock price at time 0. These are cumulative normal distribution functions, capital N, the bell-shaped curve. They have arguments I'll talk about in a moment. There's the strike price, the price that you can purchase the stock for under the call contract. There's a constant interest rate R in this model. This is in my simple model, the interest rate was 0, but there is some interest rate at which you borrow and lend between periods, and it shows up right here. And then the arguments of the cumulative normal D plus and D minus are given down here. And in addition to all the parameters we've talked about, there's one extra parameter, sigma, the volatility of the stock that shows up here. It's a measure of how risky the stock is on which the call is written. Any model has assumptions. In fact, the whole business of modeling is that you look at reality and you say, let me build some mathematical idealization of this reality and try to capture the important features and leave out the less essential features, because if we tried to capture everything, we would build a model that was so complex that it would be useless. So we want to capture the important features, leave out the less important features. And the Black-Scholes model has assumptions as well. Let's look at what they are. I forgot this. So the Guardian has referred to this formula. You should know that we're handling controversial topics here. The Guardian newspaper has referred to this formula as the mathematical equation that caused the banks to crash. I think that is completely bogus, and I'll try to explain why in just a moment. Okay, what are the models in Black-Scholes? What are the assumptions in the Black-Scholes model? Well, the first is that you can borrow or invest at the same constant interest rate over the interval between the initiation and the expiration of the call. Secondly, at each time, the buying and selling price for the stock is the same. That is, there is no bid-ask spread on this stock, and you can trade as many shares as you desire at this price. Thirdly, the stock is a continuous random process. Continuous means that the stock price moves, it doesn't jump, it moves continuously over time. Fourthly, there is no arbitrage in the model. What is arbitrage? Arbitrage is the ability to start with 0 initial capital and trade in such a way that at a later time you have positive money for sure. So turning nothing into something with no risk of loss. This model has two assets that you can trade in. It has a stock and it has a money market account with a constant interest rate. And the Black-Scholes assumption is that there is no arbitrage. There is no way to turn nothing into something with no risk of loss. And so the stock price has to be so unpredictable that one cannot create an arbitrage by trading in the stock and funding that trading by borrowing or investing at the interest rate. And finally, the stock has constant volatility, sigma, the sigma that showed up in the Black-Scholes formula on the previous page. The first four of these assumptions in most situations are innocuous. They're not quite right, but they're close enough to being right that this model is useful. The last assumption is clearly wrong. It was right up until the 1987 crash, and then the world changed, and it hasn't been right since then. But let me tell you what this last assumption is before we think about weakening it. So what is volatility? Let's suppose we look at an interval of time. Let's suppose a month. So here's T1, the first day of March. Here's T2, the first day of April. Okay. Inside that month, we divide time into shorter intervals, perhaps daily. So these T1s would be closing, the close of business trading days. So we put subdivisions inside. And each of these subdivisions, we look at the relative change of the stock price. So I look at the price at the end of the day minus the price at the end of the previous day. Change in price, divide it by the stock price from the end of the previous date. So to get a relative change, square it. and then sum it up, in this case, across the month. The answer you get should be close to the interval of time over which you're computing, in this case 1 month, so this actually we do this in years, so it would be 1/12 of a year, times a constant sigma squared. And what do I mean by close? Close is not a mathematical concept. Well, I mean that if you take a limit as the number of intermediate points goes to infinity and the distance between them goes to 0, that limit is exactly sigma squared T2 minus T1. And that should work no matter what interval of time, T1 to T2, you choose. So if we do it for the month of March, it should give me the same answer with the same sigma squared as if I do it for the month of April or the month of May. That's the assumption of constant volatility. That assumption's too strong, we know. Okay, so this is the stuff in the Black-Scholes model, and then they kicked off this revolution of quants working in finance with this model. And as I say, from 73 to 87, this model was right. I mean, it performed really well. If we're going to extend the Black-Scholes model, and we do want to extend it, we want to allow volatility that's not constant, then we're going to have to figure out a different way of looking at that model. So far, I've talked about how to price options by replicating. What's the initial capital I need to start with so I can trade in the market and produce the payoff of the option, regardless of which path the stock price follows. Pricing equals replication. There's another way to look at this pricing that makes life a little simpler and would allow us to extend the Black-Scholes model. It's difficult to extend the Black-Scholes methodology to more complex situations because it's difficult to compute those replicating trading strategies in the more complex situations. And it turns out there's a shortcut. We don't actually have to compute those complicated replicating trading strategies in order to figure out what prices of options are. And let me go back to my original model and show you the shortcut there. So here is the stock price we began with. Here is the call price, and I said the call price at time 0 is 1. That's what I need in order to replicate the call payoff by trading in the stock and the money market account. Let's do this somewhat more generally. This is the mathematician, right? The mathematician takes the numbers away and puts in letters. My wife is fond of telling people that I'm no good with numbers. I'm a mathematician. And she cites the way the checkbook got messed up to prove it. So let's put the letters in. So let's start with some initial capital x0. In our example, x0 was 1. Let's buy a certain number of shares of stock. In our example, we bought 1 share of stock. The delta 0 was 1. Delta 0 is the number of shares of stock we buy at time 0. Let's figure out what our cash position is. Well, if we started with initial capital x0, we bought delta 0 shares of stock. The stock is selling for S0 a share. Then the initial capital minus what we spent on the stock would be our cash position. And in our original example, if you do that, we started with $1. We bought a share of stock at $2 a share. That left us with a cash position of minus 1. We borrowed $1 in that original example. We'll have a 1-period interest rate. So this dollar that's getting borrowed here, some interest rate's going to be applied to it. In our example, it was 0, but now I'm going to allow the possibility that it's something not 0. And then let's think about how much is our portfolio going to be worth at time 1. We'll do both the case that we get a head on the coin toss and we get a tail on the coin toss. Right? It's a random amount. It depends on that coin toss. If we get a head, the value of our portfolio at time 1 is, well, at time 0, we bought delta 0 shares of stock. At time 1, that's selling for S1 of head dollars. It was 4 in the example, but it is whatever it is in general. And in addition, at time 0, we had cash x0 minus delta 0 S0. And at time 1, we'll have to apply the interest rate to that. So we'll have that cash plus the interest rate applied to it. Of course, this is negative. It just says we're farther in debt than we were before. If we get a tail on that coin toss, this works the same, except right here I put the stock price at time 1 if I get a tail. So that's the value of my portfolio at time 1 in the two cases. And in my example, I wanted to set things up so that this value of my portfolio at time 1 agreed with the call payoff at time 1. But now let me do something different. Let me come up with something called pricing probabilities. So I'm going to look for two numbers. I'll call them P tilde and Q tilde. I want them to have two properties, well, more than two. I want them to both be positive and then satisfy two equations. I want them to add up to 1, and I want this second equation to work out. Let's talk about these two equations. The first equation, I want them to add up to 1, and so I'm going to call them probabilities. We tossed a fair coin. The probabilities of head and tail were half and half. But I could imagine that the coin was somehow biased, and maybe the probabilities are not half and half. Maybe they're, say, 1/3 for head and 2/3 for tails. I could think of those as probabilities for a biased coin. And anytime I have two numbers that are positive and they add up to 1, I could pretend that those are the probabilities for my coin toss, even though they're not really the probabilities. And the second condition says that if you pretend these are probabilities, P tilde and Q tilde, and you take the expected value of your stock price at time 1, so there's a P tilde probability that the stock price at time 1 is S1 of head, and a Q tilde probability that it's S1 of tail. So that's the expected value of my stock price at time 1 using these fake probabilities, that I get the stock price at time 0 inflated at the interest rate. So on average, the stock price is growing at the interest rate. That's what that says. If these were the probabilities, which they're not. Let me write down the equations that we had on the previous page. The only difference is that I've distributed this 1 minus 1 plus r. These terms, x0 and delta 0, s0, were together inside a parenthesis. And now I've distributed the 1 plus r through. Those are the same equations that we had. Let's multiply the first one by P tilde and the second one by Q tilde. I multiply this guy by P tilde, so I'll get on the left I'll get P tilde x1 of head, and the second one by Q tilde, so I'll get Q tilde x1 of tail. That's all right on the left. On the right, if I multiply this by P tilde and this by Q tilde, the delta 0 is common, so I can factor it out. And I have P tilde S1 of head and Q tilde S1 of tail. If I multiply this by P tilde and this by Q tilde and add them up, because P tilde and Q tilde add up to 1, I'll just get this, 1 plus R x0. And the same here, I'll just get this if I multiply it by P tilde, this by Q tilde, and add them up. I've highlighted some terms here, the red terms. And what you can see is that because of my second equation, the red terms here will cancel. Here I have the expected value of the stock at time 1, and here I have the stock at time 0 inflated at the interest rate. And in both cases, the term is multiplied by delta 0. Here a delta 0, here a delta 0. And so those just cancel out. And so I come down to this, using equation 2, I come down to this very simple formula. Why is this important? We were trying to figure out how much money we need to start with in order to do a replication. And now we've got a formula that involves how much money we need to start with in our portfolio. And I can solve this formula for x0. I just divide by 1 plus r, and I'll do that here on the next page. I just divide by 1 plus r, and I have a formula for x0. And we remember that we wanted x1 of head to agree with the call payoff of head, and x1 of tail to agree with the call payoff in the event of tail. And so if I plug that in, for x1 of head, I plug the call payoff, and for x1 of tail, I plug the call payoff of tail. Plug that in, I get a formula for how much initial capital I need in my replicating portfolio. And I haven't figured out what the delta 0 is. I haven't figured out how to do the replication, but I have a formula that tells me what's the initial capital I need to start with. So that's a nice shortcut around the replicating argument that was in the Black-Scholes original paper. In this particular case, C1 of head, the call payoff in the event of head was a 3, and the call payoff in the event of a tail was 0. So in the particular example we looked at, x0 turns out to be 3 P tilde. And what is P tilde? Well, The equation that we have to solve is that the expected call price, the expected stock price at time 1, S1 of head times P tilde plus S1 of tail times Q tilde is equal to 1 plus R times S0. Here I am filling in all the numbers. I'll give the slides to the department so they'll go up with the talk and you can verify this if you want to. The solution is that P tilde has to be 1/3 and Q tilde is 2/3. And so once you plug 1/3 in right there, you get that you need to start with $1 in your replicating portfolio. I should say, this is called the risk-neutral pricing formula. I'm calling P tilde and Q tilde pricing probabilities. Everyone else in the world calls them risk-neutral probabilities. As soon as someone calls them risk-neutral probabilities, someone else tries to explain why this formula works with words, all about risk-neutral investors and suppose you lived in a risk-neutral world. And I always find that very confusing. So I'm going to call them pricing probabilities and not say anything about any risk-neutral world because I don't believe in that. So suppose we wanted to price a put option. So I have the same stock price as before. It starts at 2 and it either doubles or halves depending on the coin toss. And a put option permits its owner to sell 1 share of stock, let's say at time 1 for $4. So if the stock goes up to $4, I have the right to sell it. This put option gives me the right to sell it for $4. Well, that's not worth anything. But suppose the stock price goes down to 1 and I have the right to sell it for $4. What would I do? I would buy it on the market for 1, use my put option to sell it for $4, and make a $3 profit. And so the put option would be worth $3 in that event. And now the question is, what is the put option worth at time 0? Well, you could sit down and you could figure out the replicating portfolio again, but you could also just use the risk-neutral pricing formula. The risk-neutral pricing formula says the put option at time 0 is 1 over 1 plus R, and then the expected payoff of the put at time 1. The risk-neutral pricing probabilities, the pricing probabilities are exactly the same. They only depended on what the stock price was and the interest rate. So you plug in 1/3 and 2/3, and you get a 2. And now we know what the initial capital is we need to replicate the put without having figured out how to do the replication. That's your homework problem. So now that you've got $2, how are you going to trade in order to replicate the payoff of the put? You'll have to sell the stock short in order to do that. That is, you'll have to own a negative number of shares of stock. Seems like it should be illegal, but it's not. So there's this notion called risk-neutral pricing. The risk-neutral pricing idea is we find a probability measure. I was talking about P tilde and Q tilde, but in real models, you have infinitely many possible movements of the stock price, and so you can't just talk about probabilities, you have to talk about a probability measure. We need to find a probability measure under which the expected rate of return of the risky asset is the interest rate, and this is the pricing probability measure. And then to price some derivative security like a call or a put, you take the payoff it's going to give you at the final time, you use the interest rate to discount it back to the initial time, and then you take its expected value using these pricing probability measures. And that'll give you the initial capital. And there's an important theorem here which says that if you build a model that is free of arbitrage, it will always have a way of choosing this pricing probability measure. That's an if and only if statement. Okay? The model is free of arbitrage if and only if there's a way to choose a pricing probability measure that you can use to play this trick with. There is discussion in the finance industry about whether arbitrage exists or not. There are those who say, well, it exists because you see people all the time doing things that take advantage of it. And there are others who say, well, it doesn't exist because as soon as it does, somebody would take advantage of it and it would disappear. So that debate will never end. But we're talking about mathematical models here, which are idealizations of the real world. You do not build a mathematical model that has arbitrage in it. You build a mathematical model for a purpose. You'd like to know how to price things or how to hedge things or how to invest. Any question you ask a mathematical model that has an arbitrage in it will have a nonsensical answer. Because if your model allows you to take nothing and turn it into something with no risk of loss, then all kinds of weird things become possible, and the model is useless. So if you have a mathematical model with arbitrage, start again. If you implement that model at your firm, you are going to lose your job. So models should not have arbitrage, and here's a nice, necessary, and sufficient condition to guarantee that any model you build is free of arbitrage. You have to be able to find a pricing probability measure that you can use to play this game with of computing the prices of derivative securities. Now, there's a problem here, which is that I didn't say the pricing probability measure was unique. And what if you find one pricing probability measure and you go out and start pricing things, and I find a different pricing probability measure and I go out and start pricing things, and we're getting different prices for these derivative securities? Well, that's a problem. And the second fundamental theorem addresses that problem. It says, let's assume, first of all, that the model is free of arbitrage. Then every derivative security can be replicated if and only if the pricing probability measure is unique. And that theorem cuts in two directions. One of the directions it says is that it guarantees, gives you a condition under which the pricing probability measure that is unique. That's nice. But going the other direction, it gives you a condition under which every derivative security can be replicated. If I use this shortcut of using the pricing probabilities to figure out what is the initial capital, then I'd like to know that from that initial capital, I can actually replicate the derivative security, and this theorem tells me the condition that guarantees that is possible. The markets that have this nice property are called complete markets, and those are the good ones. I'm sorry, the models. Those are the good ones. Here, let me give you some examples of models that reasonably can be modeled. Let me give you some examples of markets that can reasonably be modeled by complete markets. I'll say that one more time and try to get it right. Let me give you examples of real markets that can reasonably be modeled by complete models. Options on indices. Options on any liquidly traded stock. That's where Black-Scholes began. And in that case, a complete market makes sense. Risk-neutral pricing makes sense. All the replications you want to do are possible. I should point out that hedging is the flip side of replication. If I sell you a call option and I know how to replicate it, I have a hedged position. When I sell you that call option, I've incurred a liability. I may have to pay off. If I replicate, the replicate enables me to pay off for sure. And so I have a hedged position. I'm not actually exposed to risk from having sold you that option. Whenever you're thinking about complete markets, you're always thinking about how are you going to do the replication, and that's why it's important that we're talking about options on liquidly traded stocks, because we have to trade in those stocks to do the replication. Derivative securities based on interest rates. It makes sense to model those as incomplete models. Black-Scholes began with equity options, but there are lots of interesting options on interest rates. Interest rate caps, for example. You can get an interest rate cap on your mortgage. Or interest rate swaps. You can swap a fixed interest rate loan for a variable interest rate loan. Those can reasonably be modeled by complete models. Derivative securities based on foreign exchange rates for free-floating currencies can reasonably be modeled by complete models. Prices of commodities which have an actively traded futures market, because you trade in the futures market to do the replication. And then there are those for which a complete model doesn't make sense. Let me give you a couple of examples. Security subject to default. If a security can default, you need to figure out how am I going to hedge if I own that security against the possibility of default? Or how would I replicate that default? Well, there is an exception. I could replicate it if the security is issued by a single entity and there's a credit default swap available for the issuing entity. A credit default swap is sort of like an insurance contract on default. That would give you the ability to replicate. But in the absence of that, these models are incomplete. These markets are incomplete and should be modeled using mathematical models that are incomplete. And derivative securities in illiquid markets, such as real estate. Certainly, any model of that should be incomplete to capture what's really going on in the market. Part of what happened, I should say here, in the financial crisis is this distinction between complete and incomplete markets and models just got lost completely in the lead up to the real estate crisis, the mortgage-backed security crisis. There is a danger when models are incomplete. We can build mathematical models in which replication is not even approximately possible. Such models are called incomplete. And incomplete has more than one pricing probability measure, so we can have disagreements about what the prices of securities are. All the pricing probability measures will give market prices for securities that are quoted in the markets, but it's the other things, the things that are not being quoted in the market, not traded on exchanges, but being traded over the counter, where the difference may show up. And when pricing probability measures disagree about the price of a derivative security, that derivative security cannot be replicated. A position in that derivative security cannot be hedged, and that's where the danger is. And this is the point that was forgotten, I think, in the financial crisis. So what's the role of quants in the financial crisis? So replication in the mortgage-backed securities markets is not possible. The quants thus built incomplete mathematical models for these markets, which was the right thing to do. But in some cases, I must say, the quants, the people who went through my program, I think in some cases, didn't understand the difference between complete and incomplete models. But in most cases, the quants knew the difference, but the traders chose to ignore it. There's money to be made if we ignore this subtle point, so let's just ignore it and trade. And so large positions were taken by financial firms, confident that since mathematical models had been used, that most people didn't understand, that these models had computed the prices of the assets being bought and sold, the prices must be correct. And the most important reason, I believe, to know what's going on in these models is so you know when not to trust them. Every model is an idealization of reality. Sometimes that idealization is close enough to reality, and sometimes it's not. And the only way to know whether this model is reliable in this situation is to understand both the market and the model, and to understand whether there's a good match. And that got lost. And it got lost with mortgage-backed securities. So let me just talk a moment about what mortgage-backed securities are, and we can see how it got lost. Let's go back to the savings and loans. So the savings and loans were popular in the 70s and 80s, and they still exist to some extent, but not to such an extent. And let's talk about the concept of a savings and loan. How did that work? So your local savings and loan in Milwaukee was a place where you could go and deposit your money. It would collect deposits from a lot of retail investors, university professors, and other people who don't have a lot of money to give, so there's a narrow arrow there. And they would combine those into larger lumps of money and lend them out for people's mortgages. There is a fundamental problem here called duration mismatch. The duration mismatch problem is that the depositors may withdraw their money at any time, but the mortgage payments come in on a monthly schedule. Now, it is possible that people will prepay their mortgage. They might pay their mortgage early. That does happen frequently. People sell a house, pay off the mortgage, and move to a bigger house, or change jobs and move to a different city, so they have to sell their house, or they just refinance their mortgage, and so they pay it off early. So the borrowers may prepay, but usually not when the savings and loan wants them to, right? Not at the time when all these guys are demanding their money back, and so there is a possibility of a run on the bank. And that, in fact, happened in the decade between 85 and 95. There was a savings and loan crisis in this country. The federal government had to bail them out, and there was $130 billion, I believe, the GAO, General Accounting Office, estimated that it cost the taxpayers to bail out the savings and loans. About a third of the savings and loans in this country failed in that 10-year period. And mostly it was this duration mismatch that caused this to happen. So how do we deal with that? Well, we don't have this problem anymore. So clever people have figured out the following. I'm going to do it in a simple case, and then we'll make it a little more complicated. Here's a simple case, here's a simple case that illustrates how we can deal with this problem. Let's suppose we have a pool of 5 identical 30-year, $100,000 mortgages. Okay, 5 people, each want to take out a mortgage, 30 years, $100,000. Now, let's suppose that 2 of those borrowers are going to pay off the mortgage at the end of 3 years. 2 more are going to pay off the mortgage at the end of 5 years, and the third one is going to wait all the way to the end, 30 years. Actually, as I said, people often pay off their mortgages early, and at least before the most recent financial crisis, the average duration of a 30-year mortgage was 7 years. So people actually paid their mortgages off much earlier than 30 years. What we'd like to do now is we'd like to find 5 investors, each with $100,000 to invest, and 2 of those investors want to invest for 3 years, and 2 for 5 years, and 1 for 30 years. And then we just match the investors up with the mortgage oars, right? That's easy. Well, of course, we never quite have this kind of a neat situation. And in particular, we don't know in advance when the borrowers will pay off their mortgages. But there are statistical prepayment models that predict the distribution of prepayment dates for mortgages. So we know, if you give me a pool of mortgages, we know how many are going to pay off in what time frame, right? Because we've studied that. And let's make it simple, and let's suppose that we've got our model, and our model says, yes, 40% of the borrowers will prepay at the end of 3 years, 40% at the end of 5 years, 20% will hold the mortgages for 30 years. And then we go out and we find our 5 investors, 2 of whom want to invest for 3 years, 2 of whom want to invest for 5, and 1 of whom wants to invest for 30. But we know that this is the way the prepayment's going to go, but we don't know which of those 5 mortgagors is going to pay off when, okay? We've got our 5 investors, and they want to invest 2 for 3 years, 2 for 5 years, 1 for 30 years. We've got a pool of 5 people who are taking out mortgages, and we know from statistics that in that pool, 2 will pay off in 3 years, 2 will pay off in 5 years, 1 will hold it for 30 years, but we don't know which ones are which, and we want to match them. So we'll find our 5 investors, and then we will just say, okay, to the first 2 investors, the 2 who want to invest for 3 years, you're going to receive the mortgage payments from 2 mortgages, and you will receive the principal from the first 2 prepayments, whoever they are, whenever they pay. And then to 2 investors, the ones who want to invest for 5 years, we'll say you will receive the payments from 2 mortgages, and then you will receive the principal from the next 2 prepayments whenever they occur, whoever they are. And then we say to our last investor who wants to invest for 30 years, you'll receive the mortgage payment from the one surviving mortgage that goes on for 30 years. So you can put it sort of schematically this way. You put a pool of 5 mortgages together, and you tranche it. So here's the bottom tranche. It goes from 0 to 40%. Then this is called a mezzanine tranche, from 40% to 80%. And then the senior tranche goes from 80% to 100%. You take the 2 investors who want to invest for 3 years, and you sell them this tranche. We don't yet know who belongs in this tranche. But what they're going to receive is they're going to receive monthly payments from 2 mortgages, and they'll receive the principal from the first 2 prepayments, and then they're done. In this tranche, the 40 to 80%, these guys, 2 investors, will buy this. They will receive the monthly payments from 2 mortgages. They'll receive the principal from the second 2 prepayments, and then they're done. And the investor who wanted to invest for the long term, you sell him this tranche up here, and he'll receive monthly payments from 1 mortgage and the principal from the last prepayment. And now you've done a pretty good job of matching how long the investors want to invest with how long the mortgages go. And of course, you don't have to do this with 5 mortgages. You could put 100 mortgages into the pool. And you don't have to do it with 3 tranches. You could do it with a dozen tranches. And then you would get a very good match between what the investors want to invest what the mortgages, how long the mortgagors want to hold the mortgage. And in addition, you could offer the different tranches to the different investors with monthly payment rates that are different from those generated by the mortgages. Here I've said they get the monthly payments from 2 mortgages. But if you think about it, in today's low interest rate environment, the interest rates are low now, but they're expected to go up in a few years. If you're investing for a short term, you should be willing to accept a low interest rate because interest rates are low. But if you're investing for a long term, you're going to demand a higher interest rate because interest rates are going to go up eventually and you don't want to get locked into this low interest rate. So in today's environment, this guy should get a higher payment, higher monthly payment than from 1 mortgage. These guys probably a lower monthly payment than from 2 mortgages. Figuring out how to do that is a tough mathematical problem. So this has been a triumph of financial engineering, but it creates a tough mathematical problem. Tranching pools of mortgages to provide securities with desired durations made it possible to have mortgages financed by major investors, that is pension funds, sovereign wealth funds, rather than by retail savers. And that changed the nature of the mortgage market. This is intermediation, moving capital from investors to mortgage borrowers. It's a win-win. It's made life better for the borrowers. It's made life better for the investors. But determining the rates to offer for the different tranches requires some complex mathematical models. Liar's Poker by Michael Lewis tells the story about this in a very entertaining way. Michael Lewis is a very entertaining writer, and he tells the story about Louis Ranieri, who started in the mailroom at Salomon Smith Barney, eventually became a trader, and figured out this mortgage securitization that I've just described to you, tranching the mortgages. And in 2004, Business Week named him one of the greatest innovators of the past 75 years, and claims that mortgage securitization, this process of tranching that I've just described, cut the mortgage rates by 2 percentage points. I noticed that recently Time Magazine said that he was on the list of 25 people to blame for the financial crisis. And Mike Ranieri says, mortgages are math. So that was the good. Let's talk about the bad. And the bad is the following. There's actually 2 risks if you think about a mortgage. There's the risk of prepayment, which we've talked about. There's also the risk of default. And the mortgages in the pools that were tranched in the 1980s, providing investors securities with desired durations, had negligible default risk. But the demand for mortgage-backed securities outstripped supply. And so additional mortgage-backed securities were created. And why did it outstrip supply? Well, there were 3 sources of demand. One of them was that regulated entities, such as pension funds and insurance companies, are required to have a portion of their investments in highly rated fixed income securities. And these tranches of mortgage-backed securities did that. U.S. interest rates were low, and this led investors to seek securities with higher returns than government and corporate bonds. And these tranches of mortgage-backed securities did that. And finally, the U.S. balance of payments deficits has put trillions of dollars in foreign hands. And if you own U.S. dollars, the only place you can invest that is in the U.S. And the biggest market in the U.S. is the mortgage-backed security market. And so that's where that money landed. And this created more demand than there were mortgage-backed securities to supply that demand. And consequently, the investment banks started creating more. And when they started creating more, they needed more mortgages, and the place they looked were mortgages that were subprime, that had a higher default risk than the ones that had been tranched in the past. And they thought, well, we can do the same thing. What we'll do is we'll take a pool of 100 risky mortgages, default risky mortgages. We'll put them into a pool like this, and we'll tranche. So we'll typically put in more tranches at the bottom, 10%, 20%, 30%, and then we'll put all the rest up here. This is called the equity tranche. It's the most risky. This is called the super senior tranche. It got AAA ratings, and perhaps deservedly so initially from the ratings agencies. And what happens is if you buy this tranche, what you're going to get is you're going to get high payouts, but those payouts are going to be reduced as soon as somebody in that pool defaults. And if 10% of that pool defaults, you're wiped out. All of your investment is gone. And then the mezzanine tranche will not see any losses until the equity tranche, 10% is defaulted, and then the defaults will begin to move into this tranche. The super senior tranche will not see any losses due to default unless 30% of this pool defaults, and then the next default will affect the super senior tranche. How likely is that to get 30% of a pool of mortgages to default? Well, that depends. Let's jump ahead. That depends on correlation. And let me just illustrate it with a very simple example. Let's suppose we had 100 identical mortgages, each with a 10% probability of default. Let me model that by saying Xi is a random variable that's a 1 if mortgage I defaults, and it's a 0 if it does not. And S is the sum of the Xi's. It's the number of defaults we see in the pool. And I need to compute what is the probability that we see more than 30 defaults. What's the probability that that super senior AAA rated tranche gets hit? If the Xi's are independent, then you can use the central limit theorem and you can do a calculation, and you can see that the probability that that super senior tranche gets hit is infinitesimal, 10 to the minus 11th, right? It's not going to happen. It's like winning the lottery, which also never happens. If they're all perfectly correlated, as soon as one defaults, they all default, and so the probability that the super senior tranche gets wiped out is 10%. That correlation, how closely related these defaults are, that's the critical parameter. Before the crisis, it was believed that mortgage defaults from different parts of the U.S. have low or even zero correlation. What does the housing price in Milwaukee have to do with the housing price in Pittsburgh? The truth of the matter is that in a crisis, correlations always increase, and in marketing of securitized subprime, the marketing of subprime securitized mortgages created a bubble in the housing market, and when it burst, all parts of the U.S. behaved similarly, and so the default went to almost 1. The default probabilities calculated before the crisis were orders of magnitude too small. The second major mistake is the pre-crisis belief that we had these strong mathematical models, and when we applied them to finance, they permitted us to correctly price and hedge derivative securities. And the truth of the matter is that there are no instruments for accurate hedging of mortgage-backed securities. Those are inherently incomplete. The models we have for mortgage-backed securities are incomplete at best. In most cases, they're not even dynamic. They don't even have the concept of hedging in them. And in addition, there was confusion between the actual probability of default and the probability of default under the pricing probability measure used in the models. You can see in the literature, you can see in conversations with people that they didn't really understand that there were two probability measures running around. So where are we going from here? Well, we're going to wrap up soon because it's almost 5 o'clock and I shouldn't go long. We have already seen that we have more stringent regulations. The regulators are requiring the financial firms to hold far more reserve. The amount of risk capital is determined by detailed calculations applied to the portfolio held by the firm, and the financial firms have brought this on themselves. But on the other hand, the calculations they're required to make often have little sense. And in fact, they sometimes incentivize those firms to do things that are counter to their role as financial intermediaries. And they're also making the financial system less stable by forcing these firms to march in lockstep. Really, the crisis was precipitated by the default of Lehman Brothers. And people said, oh, the Fed will let a bank default. And they suddenly all together tried to raise capital. The regulations that we have in place now require that if there is some big event, altogether, the banks are going to have to try to raise capital. And they will again be forced to sell off their assets at fire sale prices. And in addition, through forced mergers and acquisitions, the firms that are too big to fail have gotten bigger. So not too encouraging on that front. Let me jump through this. Yes, I wanted to make this conversation. Here's a conversation that I've heard from many of my former students in the industry. It went something like this. The senior management would come to them and say, everyone is making money, why aren't we? And they would say, model risk. That means the models we have are not sufficiently accurate for what the real market is, that we should trust them to take big positions. Model risk. And the way that conversation invariably ended was, everyone's making money, you make money too. At this point, I think the two players need to have a more substantive discussion. How much do we trust these models and why? And knowing this, how big a position are we willing to have in the market being modeled? And for that, the senior managers have to understand something about the mathematics as well as the quants in the trenches. This turns out, I think, to be a good time to get into quantitative finance. It needs mathematics, it needs statistics, it needs scientific computing. The financial firms are expanding their risk management groups in order to comply with regulations, and that requires that skill set. The people who understand the models have more clout in the firms than ever before. And we still don't have good mathematical models for the securities that were the direct cause of the crisis. And developing those models is a challenging mathematical task. And even trading, which in the past has been the purview of college dropouts, is now being done algorithmically, which means that it's dependent on math, statistics, and computing. And my parting thought about this is the finance industry is critically important to our economy. It's so important, in fact, that we really need people who have integrity and good quantitative skills to choose it as a career. And I fear that one of the worst consequences of the crisis we had is that people now have come to regard it as a dirty industry, something they don't want to get into. And I think we as a nation will suffer if that belief persists. So now it is past 5 o'clock and I should shut up. Thank you.
Time for a few questions. Anyone want to volunteer? First one out of the gate. No. Oh, yes, over here.
Well, you made a point a slide or two back about the government forcing these financial industries or companies to merge. So actually, the government was forcing them to merge. So now we have
the government forced Bank of America to acquire Merrill Lynch when it did not want to. The government forced J.P. Morgan to take on Bear Stearns when it really did not want to.
Right, so this is off topic of your lecture, but that seems very counterintuitive. The government, they had to bail out the too big to fails.
So the government's first line of defense, if a firm got into trouble, was to find a white knight, another firm that was willing to absorb it. When that didn't work anymore, so there was some of that went on, like Merrill Lynch, Bank of America, and Bear Stearns, J.P. Morgan. And then Wells Fargo, acquired Wachovia. And then when this didn't work anymore, Bank of America acquired Countrywide. When this didn't work anymore, then the government went to the Troubled Asset Relief Program to bail out the firms. But the first line of defense was to force mergers. And so we have fewer and bigger firms than we had before the crisis. Too big to fail has gotten worse.
Just a few firms walking in lockstep, and when they fall.
We have a few firms, and they're being forced into lockstep because they're all subject to the same regulations, which forces them to hold a certain amount of capital. And in the event of a crisis, if that's not relaxed, they will all have to go to the fire sale together, which was what happened last time. And then what happened when they were all forced to go to the fire sale together, they started husbanding their cash, they quit lending, and they shut down the economy.
So are the flaws in the regulations, are they because of politics and bad decisions, or is it just impossible to come up with a group of rules that aren't going to be manipulated or have big flaws in them?
I wish I knew what the answer was. This is a little bit dangerous because I'm being recorded, but I will say that I would feel a lot better if individuals were going to jail. Because the incentive, if you think about the incentive when you're making a decision, if I can do this, I shouldn't do it, but if I do it and I get $1 million bonus, and the worst that can happen to me is that I get fired and my firm gets a big fine. That's a different kind of calculation than if the worst that can happen to me is I get 10 years in prison. And so I believe that holding people accountable would be much more effective than imposing regulations on the banks. That said, I think they do need to they were running dangerously low on risk capital. They were operating with only a fraction. What happens is that there's all these trades going through the bank, and they have just a little bit of capital. And so if something goes wrong, they are quickly in trouble, and we saw that. And they do need to hold risk capital. And so I think requiring them to hold risk capital is a good thing. The particular rules that are enforced sometimes make sense and sometimes don't.
Why do you think that the constant volatility assumptions that we're thinking about after 87
Why do I think that the constant volatility assumption is not correct?
not correct anymore, and it was before?
Well, the reason it's not correct anymore, we can see it in the marketplace, because if it were correct, then when you were pricing options on the same asset with different strike prices, you could use the Black-Scholes formula with the same value for the volatility.
But that's not the reason.
That's an observation. Yeah. So I think what happened was that in the early years, the heady years of Black-Scholes, the traders were so firmly convinced of the correctness of that formula that they sort of made it be correct by their trading decisions. And after the crash of 87, people realized, oh, there's a bigger risk, downside risk than we realized. And puts are a good way to protect against that downside risk. And so I will especially puts on the S&P 500. And so I will bid up the price of those puts. And at least that happened. I think that's part of the explanation. There's more about what traders have on their books. And when a trader makes a decision, he's thinking also, do I really want to make this trade looking at the position I already have, and does it add too much risk? And that's a fairly complicated analysis they do.
One more question. Right here.
This is sort of a basic model question. So I guess the idea is in the model that if someone pays their mortgage, so you're talking about the model where people pay off early. That's actually kind of bad for you as an investor because you don't collect all the interest down the road.
That can be either bad or good for the investor, right? It depends on what rate of return the investor is getting on that investment. Can you repeat the last part of your question?
I can't remember the exact words, because I guess my idea was, it seemed like the people that got the payoffs first were at the bottom of the trench.
The people who get the payoff first are at the bottom. That's right. And that can be either bad or good, right? Suppose if we're in a high interest rate environment and I make a loan to you and then the interest rate goes down. I would like that loan to stay alive because you're paying me a high interest rate. And if you pay off early, I've lost that high interest rate. On the other hand, if we're a low interest rate environment, I make a loan to you and the rates go up, I'd like you to pay me off so I can reinvest that money at a higher interest rate. So that prepayment can go either way, depending on the environment in which the loan is made.
All right, let's thank Professor Shreve one more time.